It is Tuesday, January 27th, 2026. And if you are holding silver right now, you need to understand what just happened over the past 72 hours. Because while you were watching the price action, while you were celebrating new highs, while you were thinking this rally would continue forever, someone pulled a kill switch. And that kill switch just erased billions of dollars in paper positions, bankrupted 44 trading firms in India, and created a price divergence between paper and physical silver that has never been this extreme in modern history. This is not about a normal correction. This is not about technical profit taking. This is about a coordinated institutional attack that used a single weapon to destroy momentum at the exact moment silver threatened to break free of paper control. And if you do not understand what this weapon is, if you do not understand how it works, and if you do not understand who benefits when it gets deployed, then you are trading blind in a rigged system. Today, we are going to show you the exact mechanism they used. We are going to show you the 47% margin requirement increase that forced mass liquidation. We are going to show you the banks that were bleeding losses on their short positions. And we are going to show you why physical silver in Japan is trading at $130 per ounce, while the paper price says $111. Because that gap, that massive disconnect between what screens show and what real metal costs, is the most important signal in the silver market right now. And it tells you everything you need to know about where this is heading. Let me start with the number that should make your blood boil. On January 7th, 2026, the CME Group, which controls the COMEX futures exchange, where paper silver trades, announced a massive increase in margin requirements. They raised the maintenance margin from $22,000 per contract to $32,500 per contract. That is a 47% increase implemented immediately. And for anyone holding leveraged silver positions, that 47% hike meant one thing: deposit more cash right now or your position gets liquidated. Before we go further, you need to understand exactly how margin works in the futures market. Because without understanding this mechanism, you cannot fully appreciate the weapon they just deployed. When you trade silver futures on COMEX, you're not buying actual silver. You're buying a contract that represents 5,000 ounces of silver. At $117 per ounce, that contract controls $585,000 worth of exposure. But here's the key. You do not need $585,000 to open that position. You only need to post margin, which is essentially a good faith deposit that you will honor the contract. Before the hike, that margin requirement was $22,000 per contract. That means with $22,000, you could control $585,000 of silver. That is more than 26 times leverage. This leverage is what makes futures markets attractive to speculators. It allows you to amplify returns, but it also amplifies risk, because when the price moves against you, those losses get multiplied by the leverage factor. Here is where it gets dangerous. Margin is not a one-time payment. It is an ongoing requirement. Every day, your account is marked to market, meaning the exchange calculates your unrealized gains or losses based on where the contract is currently trading. If the price moves in your favor, your account grows. If it moves against you, your account shrinks. And if your account falls below the maintenance margin level, you get a margin call. That margin call is a demand from your broker: deposit more cash immediately or we liquidate your position. Now imagine what happens when the exchange suddenly increases the maintenance margin by 47%. Every single trader holding a long position wakes up to find that the rules have changed. Positions that were fully margined yesterday are suddenly under-margined today. Traders who thought they had sufficient capital are now facing immediate margin calls. And they have hours, not days, to come up with the additional funds. Think about what that actually means. If you are a trader holding 10 silver futures contracts, you suddenly need to wire an additional $105,000 to your broker. Not tomorrow, not next week, immediately. And if you cannot come up with that cash within hours, your broker sells your position at whatever the current market price is. You have no choice. You have no negotiation. The exchange changed the rules in the middle of the trade, and you either comply or you are out. This is not risk management. This is a financial weapon. And the timing of this deployment was not accidental. Silver had just broken through $110. Momentum was accelerating. Short sellers who had been betting against silver for years were facing catastrophic losses. The physical market was screaming shortage with lease rates spiking to 8%. And right at that moment, right when the squeeze was tightening, the exchange pulled the trigger. Because here is what a margin hike does to a market. When thousands of traders simultaneously receive margin calls, they all do the same thing. They sell. They do not sell because their thesis changed. They do not sell because fundamentals deteriorated. They sell because the exchange forced them to. And when that forced selling hits the market, it creates a cascade. Sell orders push the price lower. Lower prices trigger more margin calls. More margin calls create more forced selling. The feedback loop accelerates until every leveraged long position has been flushed out of the system. And that is exactly what happened. Silver, which had been trading near $117 just days earlier, collapsed. The rally that had taken months to build was destroyed in hours, not because supply increased, not because demand evaporated, but because the exchange weaponized margin requirements against the bulls. Now, let me give you the historical context that proves this is not a new strategy. This is a playbook they have run before. In 1980, when the Hunt brothers were accumulating massive silver positions and the price surged toward $50 per ounce, COMEX stepped in and changed the rules. They restricted new long positions. They killed the rally. The Hunt brothers were wiped out and silver collapsed. In 2011, when silver hit $49 and was threatening to break the all-time high, the CME raised margins 5 times in 8 days. 5 times. They crushed the momentum. Silver fell from $49 to $26 in weeks. And now, in 2026, history repeats. Silver breaks records. The exchange raises margins. The rally dies. This is not coincidence. This is pattern. This is proof that the paper silver market operates under rules that favor the institutions shorting the metal and punish the traders betting on higher prices. And if you think I am being conspiratorial, let me give you a name: JP Morgan. In 2020, JP Morgan paid a $920 million fine for manipulating precious metals markets. That is not theory, that is settled legal fact. They admitted to spoofing, a practice where traders place fake orders to manipulate prices. They admitted to rigging the market for years. And today, JP Morgan is one of the largest players in the silver market. They are one of the primary dealers on COMEX. They hold one of the largest physical stockpiles of silver in the world. They have been on both sides of this trade, shorting paper while accumulating physical. So when you see a margin hike that perfectly coincides with a historic price spike, and when you see the same bank that was fined for manipulation heavily involved in the system, you have to ask yourself, is this really about managing volatility, or is this about protecting institutions that are short? The answer is obvious, but here is where it gets even more brutal. Because when the exchange pulls this kill switch, when they force liquidation on this scale, there are casualties, real businesses, real traders, real capital destruction. And the most dramatic example comes from India. In the city of Surat, which is a major hub for silver trading, 44 silver trading firms officially declared insolvency in the wake of the margin hikes and the subsequent price collapse. 44 firms, gone. These firms had combined liabilities of $425 million. $425 million in losses from a single coordinated attack. These were not amateur speculators. These were established trading houses that had been operating for years. They understood the silver market. They had the right thesis about where prices were heading. But they made one fatal mistake. They were playing the paper game. They were holding leveraged futures positions instead of physical metal. And when the CME changed the rules, when margin requirements spiked 47% overnight, these firms could not meet the calls. They were liquidated. Their businesses were destroyed. Their capital was annihilated. And here is the cruelest irony. While these Indian firms were going bankrupt because of paper price manipulation, the physical silver market in India was soaring. On the multi-commodity exchange in India, silver hit a lifetime high of 2,59,692 rupees per kilogram on January 7th. That converts to roughly $113 per ounce. So physical silver in India was trading higher than the COMEX paper price. The physical market was screaming by. But the paper traders who were leveraged on margin were getting annihilated because the system is designed to crush them when they threaten the status quo. This bankruptcy wave in India is not an isolated incident. It is a microcosm of what is happening globally. Traders who are exposed to paper silver, who are playing the leverage game, are getting destroyed. Not because they are wrong about silver fundamentals, but because the institutions that control the exchange are using margin requirements as a weapon to protect their short positions. And speaking of short positions, let me show you exactly who needed this price collapse. According to the Commodity Futures Trading Commission's Commitment of Traders report, as of early December 2025, commercial banks were net short 212 million ounces of silver. 212 million ounces. At $100 per ounce, that represents a $21 billion short position. Every single dollar that silver rises costs these banks $212 million in paper losses. When silver went from $80 to $117, that is a $37 move. That is $7.8 billion in losses for the shorts. $7.8 billion. So who do you think has an incentive to crash the price? Who do you think benefits when the exchange raises margins and forces traders to liquidate? The answer is the banks that are short. The answer is the institutions that control COMEX. The answer is the same players who have been fined for manipulation before. This is why the attack happened. Not because silver fundamentally deserved to drop, not because the bull market ended, but because the shorts needed relief. They needed to buy back their positions at lower prices before the losses became existential. They needed to reset the board, and the margin hike gave them exactly what they needed. But here is what they cannot control. They can manipulate the paper price, they can force liquidation in the futures market, they can crash the chart, but they cannot create physical silver, they cannot mine it out of thin air, they cannot refine it with a keystroke. And that is where the entire manipulation scheme starts to break down. Because while the paper price was getting destroyed on COMEX, something completely different was happening in the physical market. And this divergence, this growing gap between what the screen shows and what people are actually paying for real metal, is the most important story in silver right now. Before we examine the price differences across markets, we need to understand a critical indicator that professional traders watch: lease rates. Silver lease rates measure how expensive it is to borrow physical silver for a specific time period. Under normal market conditions, lease rates hover around 0.3 to 0.5% annually. This makes sense because silver is relatively abundant, storage is available, and lenders are willing to lend at minimal rates. But when physical silver becomes scarce, when industrial users desperately need metal and cannot find it, lease rates spike. And in early January 2026, lease rates hit 8%. 8%. That is 16 times higher than normal. This is not a minor uptick. This is a scream from the physical market that metal is extremely difficult to obtain. Think about what an 8% lease rate means. It means someone is willing to pay 8% annually just to borrow silver for a short period. They are not buying it, they are not keeping it. They just need temporary access to physical metal, and they are willing to pay a premium rate to get it. This happens when industrial users have production lines that will shut down without silver, when refiners need metal to fulfill delivery obligations, when the physical market is so tight that borrowing becomes the only option. And here is what makes this so significant. Lease rates were spiking at 8% at the exact same time the CME was raising margin requirements to crash the paper price. The physical market was screaming shortage while the paper market was being manipulated lower. That tells you everything about the disconnect between these two realities. Let me give you numbers that should shock you. While COMEX was trading silver at $111 after the crash, physical silver in certain parts of the world was changing hands at radically different prices. In Japan, reports indicate physical silver clearing at $130 per ounce. In Kuwait, $116. In South Korea, $97. Even in the United States, premiums on physical coins and bars have exploded to levels never seen before. This is what we call the Great Divorce. The paper market and the physical market are no longer speaking to each other. They are operating in two completely different realities, and the reason for this split is simple. There's not enough physical silver to meet demand at these paper prices. Let me explain why. The paper market can print infinite contracts. They can create synthetic ounces with a computer, but the physical market cannot. Physical silver has to be mined, refined, fabricated, and delivered. And every step in that process takes time, energy, and real resources that cannot be faked. Right now, the physical market is screaming shortage. COMEX registered inventories, which is the silver available for immediate delivery, have plummeted by over 70% since 2020. That means the amount of silver sitting in vaults ready to be delivered to contract holders has collapsed. We are talking about a drop from hundreds of millions of ounces to a fraction of that. And it is not just the United States. In London, which is the other major hub for silver trading, inventories have been draining at an alarming rate. Between early January and mid-January 2026, 33.45 million ounces were physically withdrawn for delivery from COMEX. That is 26% of registered inventory in a single week. When you see that kind of drain, when you see physical metal leaving the system at that pace, it is a sign that people no longer trust paper promises. They want the real thing. And when everyone wants the real thing at the same time, the price should skyrocket. But the paper market keeps it suppressed with margin hikes and forced liquidation. Now here is where it gets even more interesting from a geopolitical perspective. On January 1st, 2026, China implemented one of the most aggressive export control regimes in modern commodity history. China reclassified silver as a strategic dual-use metal. That means they now treat silver the same way they treat rare earth elements and critical defense materials. You can no longer export silver from China without government approval, and only 44 companies have been granted licenses to export silver over the next 2 years. Why does this matter? Because China processes and refines more than half of the world's silver supply. They are the middleman between the mines in South America and the factories in the West. When China chokes off exports, they choke off global supply. And that is exactly what is happening. The immediate effect of this policy has been a spike in premiums in Asia. In Shanghai, physical silver premiums over the London spot price have reached $8 per ounce. That is the widest spread on record. Chinese buyers are panic buying physical metal because they know that once the export restrictions fully kick in, silver is going to become even harder to obtain. And here is the geopolitical angle that nobody is talking about. This is not just about supply and demand economics. This is about weaponizing commodities. Silver is embedded in every piece of modern technology. It is in solar panels. It is in electric vehicle batteries. It is in semiconductors. It is in military electronics. When China controls the flow of silver, they control the flow of technology. They control the supply chains of the West. So while the paper price is getting smashed on COMEX through margin manipulation, the physical reality is this: silver is becoming a strategic asset. Governments are realizing that without silver, you cannot build the green energy infrastructure. You cannot manufacture high-performance electronics. You cannot compete in the artificial intelligence revolution that requires massive data centers full of silver-laden components. And that brings us to the most critical question. If the physical market is so tight, if demand is so strong, if governments are hoarding and restricting exports, why is the price not reflecting that reality? The answer is that the paper market is still in control. But that control is slipping. Every margin hike, every forced liquidation, every attempt to crush the rally is a sign of desperation, because the more they manipulate the paper price, the more people realize the paper price is a lie. And when enough people realize the lie, they stop trading paper and they start buying physical. That is when the system breaks. That is when COMEX is forced to declare cash settlement because they do not have the metal to deliver. That is when the paper price becomes irrelevant and the physical price becomes the only price that matters. We are not there yet, but we are getting close. And the attack we saw with the margin hike is proof that the people running the system know it. They know the jig is almost up. They know that physical demand is overwhelming their ability to suppress prices with paper contracts. And they are using every weapon they have left to maintain control for as long as possible. So where do we go from here? What happens next? Because if you are sitting there holding silver or thinking about buying, you need to understand what the endgame looks like. You need to understand what happens when the paper pricing system finally collapses under its own weight. There are 3 possible scenarios. Let me walk through each one so you understand what to watch for. Scenario 1, the system resets higher. In this scenario, the paper market admits defeat. COMEX, seeing that physical demand is overwhelming and that inventories are drained, allows the price to rise to a level that actually reflects physical reality. That means we could see silver move to $150, $200, or even higher as the paper shorts are forced to cover and the physical premium collapses back to normal levels. This is the bullish case. This is the scenario where silver holders win big. But for this to happen, the exchange and the banks have to stop fighting the market. They have to accept that silver is repricing, and based on the margin hike we just saw, they are not ready to do that yet. Scenario 2, the divorce becomes permanent. In this scenario, the paper price and the physical price never converge. Instead, we end up with 2 separate markets. COMEX continues to trade paper contracts at suppressed prices, but nobody cares because the physical market has moved on. Physical silver trades in a parallel market at much higher prices, and the paper market becomes irrelevant. This is actually the most likely scenario in my opinion, because once trust is lost, it is almost impossible to get it back. And right now, trust in the paper market is evaporating. When physical buyers in Asia are paying $30 to $40 more than the COMEX price, that tells you the paper price has already lost its authority. In this scenario, physical holders win because they have the real asset. Paper holders lose because their contracts get settled in cash at the suppressed paper price and they miss out on the physical premium. Scenario 3, force majeure and system collapse. This is the nightmare scenario for the paper market. In this case, demand for physical delivery overwhelms the available supply in the vaults. COMEX is forced to declare force majeure, which means they cannot fulfill their delivery obligations. Contracts that are supposed to result in physical silver are settled in cash instead. And when this happens, the entire pricing mechanism breaks down. Because if the exchange that is supposed to set the price cannot actually deliver the metal, what credibility does that price have? None. In this scenario, the paper price crashes because nobody trusts it anymore. But the physical price explodes because the only way to get silver is through the physical market, and supply is finite. This has almost happened before. In March 2020, during the COVID panic, the gold futures market nearly broke because physical delivery became impossible due to logistics. The premium on physical gold coins spiked to $50 or more over the spot price. The system came within days of a force majeure declaration. They avoided it by emergency measures, but it was close. If silver goes down that path, if COMEX has to declare force majeure, it will mark the end of paper-based price discovery for precious metals. And the new price, the real price, will be set by physical buyers and sellers in a decentralized market. Now let me connect this to what we are seeing today. The attack on silver through the margin hike, the forced liquidation, the bankruptcy of 44 firms in India. These are all signs that we are moving toward one of these scenarios. The paper market is fighting for survival. They're using every tool they have to maintain control. But every time they pull the kill switch, they weaken their own credibility. Think about it. If you are a physical silver buyer in China or India and you see COMEX crash the price by $15 through a margin hike while physical premiums in your market are exploding, does that make you trust the COMEX price? No. It makes you realize the COMEX price is a manipulated fiction. It makes you focus on the physical market and ignore the paper noise. And that is exactly what is happening. Physical buyers around the world are decoupling from COMEX. They are building their own pricing networks based on actual supply and demand in their regions. And as more of the world does this, COMEX becomes less and less relevant. For those of you holding physical silver, this is why you hold. Not because the paper price is going up in a straight line, but because the paper market is dying. And when it dies, the physical market is all that is left. And in that world, you have wealth. Real, tangible, unmanipulable wealth. Let me tell you what you should actually do with this information. Because understanding what happened is only valuable if it changes your actions. First, if you're holding physical silver, do not panic. Do not let margin hikes and paper price manipulation shake you out. What you saw was a paper market attack using margin requirements as a weapon. It was not a fundamental change in silver's value. The physical market is still tight. Industrial demand is still strong. China is still restricting exports. The supply deficit is still real. What happened was noise. It was manipulation. And if you sell your physical silver because of what happened on COMEX, you are letting the manipulators win. You are giving them exactly what they want. They want you scared. They want you to sell. Do not. Second, if you are thinking about buying, understand that attacks like this create opportunities. When the paper price crashes due to forced liquidation and the physical market has not moved much, that is when the gap between paper and physical is at its widest. That is when you can buy physical at a discount to what it is actually worth. And this is critical. You have to buy physical, not paper, not ETFs, not unallocated pool accounts, not futures contracts. Physical metal in your possession. Because if you buy paper, you're exposing yourself to the same risk that just wiped out 44 firms in India. You are putting your trust in a system that has been proven over and over again to be rigged against you. Third, manage your expectations on timing. The endgame I described, whether it is a price reset, a permanent divorce, or force majeure collapse, could happen in months or it could take years. Nobody knows. What we do know is that the structural fundamentals are in place for a massive repricing. But the timing depends on how long the paper market can hold on. The shorts are desperate. The exchanges are intervening. The banks are manipulating. They are fighting with everything they have. But they are fighting against physics. They are fighting against geology. They are fighting against the fact that you cannot print silver. And in that fight, physical holders have the advantage because time is on your side. Every month that goes by, more silver gets consumed in industry. More inventories get drained. More people realize the paper price is fake. And eventually the dam breaks. Fourth, diversify your understanding. Do not just listen to one source. Do not just watch one channel. Do your own research. Look at the COMEX inventory data. Look at the lease rates. Look at the premiums in different countries. Look at the commitment of traders report. The data is public. The evidence of manipulation is there for anyone willing to look. And when you see the evidence yourself, when you understand the mechanics of how the system works, you become immune to fear. You become immune to price manipulation because you know what you're holding. You know why you are holding it. And you know the paper games cannot change physical reality. The manipulators showed their hand. They showed you that they are desperate. They showed you that they cannot control the physical market. They can only control the paper illusion. And illusions do not last forever. The 47% margin hike was not strength. It was weakness. It was proof that the system is breaking. And when it finally breaks completely, the people holding physical silver are going to be on the right side of history. So hold your metal. Ignore the paper noise. Understand the game and prepare for the end game because it is coming. The attack happened. Now you know why, and now you know what to do.